Well, well, well. PayPal has certainly had quite a year. Now, it's interesting. If you had bought PayPal pretty much any time between, say, January and August this year, you would be looking pretty smart right about now, as it has recently run up massively to damn near $80. Now, actually, I think it touched $80 maybe a week or two ago, came back down just a little bit, but it's been quite a journey for me. I got my first 100 shares sometime last year, I believe around the $59 price point. So I've been pretty happy to see this development. Granted, I had to be a little bit patient for it to start to play out, get to see the new CEO, Alex Chris, do his thing. But the question that this video aims to address, because this is the first time since I've had PayPal that it's really had a substantial run up, is the stock still cheap? Is it now too expensive? Is it now overpriced? Should I hold? Should I start considering an exit at some point? So I'm just gonna, kind of re-look at all the valuation metrics and financials, and give a few thoughts, just kind of refresh myself on the stock, reacquaint myself with it, and go from there. So PayPal's growth story is kind of interesting, right? So they had a bit of a jump during the height of pandemic times, right? And their valuation also accelerated. The market gave them a $300+ share price at one point during that time. And I think this is because people, of course, when optimism is at its maximum, will wrongly assume that random big run up in revenue growth was going to continue into the future, which, of course, it did not once things kind of opened back up. Now, impressively, they have still continued to grow revenue after this time, but the pace has definitely gotten to a more reasonable, moderate level versus that really, really rapid run up they had years ago. So certainly, yes, $300 was always overpriced, and there was like a speed run on revenue growth. Like, honestly, the trend is still more towards a digital economy, and PayPal, of course, benefits from a more digitized economy where people are doing transactions electronically and less with cash. So it makes sense why they would get a big bump from a certain big world event pushing things further in that direction at a more rapid pace than what it would unfold naturally. However, even after that event, that revenue proved to be sticky, which is, I think, a positive for PayPal, and did continue to grow because the world still is moving in that direction. It's just there hasn't been another big event that's really moved it much further along at a more rapid pace. It's just sort of naturally progressing into that direction. So the idea that PayPal is quote unquote dead business, I think people are more or less over that, especially now that the new CEO, Alex Chris, has taken over. People seem to be viewing the company more positively, which explains why it recently ran up about 29%. Free cash flow, of course, has not been as linear and straightforward, but you notice over time that they've had these individual quarters where they've had jumps in free cash flow followed by drops. And I will say the most recent big jump was the highest it had been compared to the last three. And to me, this shows that at least that they are, in some circumstances, perhaps when things are conditions are ideal, what they're capable of producing today is substantially higher. And these numbers are all, with the exception of, it looks like, one outlier quarter there where it was negative, very good. for the market cap of the company, leading to them being able to do an aggressive share buyback. And that brings me to one thing I absolutely love about PayPal over the last year or so. Okay, they've certainly been at pretty much the cheapest valuations compared to their revenue, compared to their net income, compared to their cash flow, as what they've ever been, basically, right? So in light of that, rather than do something like pay a dividend, they shelled out the money to buy back over 5% of shares. And that is exactly what I would prefer companies with a lot of cash coming in, but whose stock is trading for cheap, and with maybe limited avenues for reinvestment into future growth. I would much rather than put that money towards a buyback, because they are still growing. The shares are cheap, so they can, take some of those shares kind of out of circulation, meaning each shareholder that remains, each one of our shares, represents a slightly bigger piece today of a growing business that will be bigger tomorrow. It's a win-win-win as long as the company could do this, which is why I never really got too upset or sold when the stock was cheap. It was like, hey, those buybacks are more accretive to us when this share price is cheap. It's a golden opportunity. Like, I legit wish that they had bought back 10% or more, to be honest with you. But I'll take what I can get. And this was actually pretty good, I think, for us shareholders. This brings us to the operative question of valuation. The market cap is 81 billion, where during the highest heights, when it could do no wrong, the stock had a market cap of over 200 billion. It's been a fall from grace, and hey, falls from grace, if the business is still pretty good, can be opportunities. So we have a price to earnings of 19, price to free cash flow of 11.79, price to operating cash flow of 10.8. Free cash flow and operating cash flow closely aligned, probably due to the fact that they are not having to build all that many factories or anything like that. Now, there is a difference between free cash flow and net income on this name, and a decent little chunk of it looks like it's stock-based compensation. And there is like some depreciation and stuff on there. So, look, I would like them to cut down the stock-based compensation, at least to an extent, especially when, honestly, shares are this cheap. It has, I feel like, a more dilutive effect if it takes $100,000 worth of total compensation, for example, like just for an easy example, to keep a very talented programmer, right? And they say, hey, I'll give you half of that in stock. When the share price is as low as it has been recently, that person ends up with more shares vesting over, the vesting schedule of that stock award, resulting in a higher level of dilution. And the problem is that, like, the number of shares awarded in those programs are locked in, so a certain number of shares keep vesting over the whole vestment period, regardless of how much higher the stock goes in the meanwhile. So there's a lot of upside, and maybe that's how they're incentivizing good talent to stay around, potentially. So maybe there is a strategic vision with that, but it is a thing where over time, I would like to see them maybe work that down so that, we're not getting... Now, effectively, they do net buy back a lot of shares, so it hasn't been that big of an issue. But if the share price keeps running up, then buying back shares becomes a less good proposition for shareholders, and it gets a little bit murky. But for the moment, I think, these multiples don't imply a huge amount of stretch in the valuation, right? Like, think of any other fintech or transaction processor or anything that trades at a 19 PE. Very few, very few. And an 11 or 12 times free cash flow, even fewer. So compared to anything that might be considered a peer, especially with like the decent top line growth and such that they have, that on the surface looks pretty reasonable. Before I get into the nitty gritty of if PayPal is still cheap or not, you know what else is super reasonable? Clicking my exclusive link in the description below and signing up for Moomoo and depositing funds. Because when you do, you can get 8.1% bonus APY on uninvested cash and up to 15 free stocks. When I claimed my free stocks, I received shares of Grab, which, as you know, is one of my favorites. It's in my top 5. Additionally, you get access to multiple trading indicators, 100 plus at last count. You get margin rates that are very competitive because we know how to use margin You also get access to stocks, ETFs, options, pretty much whatever your heart desires, all in one place. Personally, I can't think of anything better that you could do with your time today. Give it a shot. Let me know what you think. So, when it comes to the question of is it still cheap? Is it now expensive? I want to say the analyst expectations have looked pretty similar for a while. I expect some of these will be adjusted soon as, market sentiment has obviously changed, and that does affect what the analysts' price targets actually show. However, these are pretty similar to what they were, I think, last time I looked at them. So I can, in retrospect, tell you kind of where I think I was. This is the past now. I think during the period where I was adding PayPal, probably more or less agreed with that average-ish area that you're seeing in these price targets, right? I thought, hey, the stock's below $60. I easily see it being worth, call it 75 or 80 on the low side, with pretty modest expectations. With, if they absolutely knock it out of the park, could be more. Okay. That was my sort of sense of it when I was getting in. And which is why I didn't get scared when it dropped a little bit lower into the low 50s for a while. And it's also why I'm not necessarily in a rush to just sell it and take my profits right this second, right? But I do want to, again, run some of my thoughts through a DCF, not as the end-all be-all, but just to kind of rework, where I'm at with it and what I'm thinking. Obviously, assumptions can change over time, and they've got, a new CEO compared to when I first started watching the stock, and that changes things. And he hasn't been on board long. He has his own vision, which may affect where some of these numbers go in the future. So this brings us to the tricky part where we have to think about, what's it actually worth? What's the DCF say? Okay, so you can put in some assumptions that look really reasonable, right? And hey, it gets you to today's value, so it's about fairly valued. And this is a pretty similar level to where I was valuing it at points in the past, right? Now, some of them might have said it was $72, and sometimes I might have come up with something like $80 or something, right? But we're kind of in a similar ballpark to where we have been pretty much all along with these numbers. But what are these numbers based off of? More or less certain analyst expectations with maybe like a little bit trimmed off because they don't really project that far into the future. And you have to assume over time, things will grow more slowly generally. But what if, and this is the part that it's hard to really model in any kind of a basic DCF calculation, right? You could make an Excel sheet or something that does this, where you can individually input years. But the problem is, it still comes down to how accurate is your prediction over time. They could surprise to the upside with a lot of the things Alex Chris is implementing at the company, in which case I think now that overall I think the perception is starting to heal in the marketplace, any major beats to the upside are going to probably result in a similar type of run up that's proportional or maybe even disproportionately high compared to the financial outperformance. So this leads me to the conclusion that at the moment, I should be hanging on and enjoying the ride, because let's face it, if I was buying stocks, individual stocks at $59, only to sell them like 11 months later at $79, that's not really the way I invest, you know? I'm pretty reluctant to sell in a lot of cases, and unless a stock, I think, has like some kind of like insane run up where I think it's fairly likely to reverse itself, or the valuation is very obviously out of line, I'm happy to stay the course while the fundamentals of the stock and the price of the stock move hopefully up in tandem together over time, because that's just an investment that sort of sits there and is a quality compounder in the background. I'm perfectly happy to hold for years because, hey, as Ron once said, set it and forget it. It's you can't really do that with individual stocks, but I like to not have to overmanage, so to speak. So unless there is some kind of major ridiculous run up or something big changes in PayPal's business, I'm probably hanging on for a good long while on this one. Ladies and gentlemen, let me know what you think. Is PayPal still reasonably priced here? Is it fair? Is it undervalued still? Is it expensive? Give me your thoughts. Love to have them. Thank you once again for making it to the end of the video. I would like to thank you for supporting the channel with your eyes and your ears. Now, if you could support it with a like and a subscribe, then you'd be a real one, ladies and gentlemen. Also, my Discord link in the description for stock-related and basically any other kind of conversation you can think of. Link in the description, always free. I don't believe in making people pay me for the mere idea of access and a conversation. Also, on the X platform at Mr. Macho Mog, if you're on Elon's little free speech sandbox, I'd appreciate a follow there. Now, if you want to support the channel directly, you can become a member, or you can sign up to today's sponsor, as both do help support the channel greatly. Also, Saturday, 8 p.m. Eastern, Cash Flow Kings Live. We are having Frank on this Saturday. He has been hiking the Appalachian Trail while letting his investments compound. I look forward to that interview. Take it easy, everyone. Have a wonderful day.